Welcome back, where we break down the biggest trends in finance and investing. Today, we're diving deep into a fascinating comparison between two unique ETFs, the MAGA ETF and the YALL ETF. If you're curious about how political considerations impact investment strategies and long-term returns, you're in the right place. First up, the MAGA ETF. This fund focuses on companies that show significant financial support for Republican candidates and causes. We'll explore how this focus on political contributions affects its sector concentration, potential risks, and performance. On the flip side, the YALL ETF takes a broader approach, looking at companies that align with conservative values beyond just their political contributions. This means it includes a more diverse set of sectors and emphasizes financial fundamentals alongside conservative principles. So, how do these differing strategies impact their long-term returns? Are you more likely to see higher volatility with the MAGA ETF or a more stable performance with the YALL ETF? Stay tuned as we break down these strategies and what they mean for your investment choices. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. Let's get into it. How do the MAGA ETF and YALL ETF differ in their stock selection criteria based on political contributions, and how does this impact the overall portfolio composition? Stock selection criteria. MAGA ETF. The MAGA ETF focuses on companies that are most supportive of Republican political candidates and causes. Specifically, it selects companies whose employees and political action committees, PACs, have donated significantly to Republican candidates over the last two election cycles. The fund includes companies from the S&P 500 that meet its criteria, prioritizing those with the highest level of contributions to Republican campaigns. This selection is purely based on donation data, without considering the industry, company size, or other financial metrics. YALL ETF. The YALL ETF, like the MAGA ETF, focuses on Republican-leaning companies, but it takes a broader and more nuanced approach. It looks at a company's donations but also considers its overall political alignment, such as corporate statements, actions, and policies that align with conservative values. This fund aims to include companies that not only support Republican candidates financially but also embody conservative principles in their business practices, such as lower taxes, limited government regulation, and traditional social values. Impact on portfolio composition. MAGA ETF. The portfolio is likely to be concentrated in large-cap companies that are active in political contributions, primarily within industries that have historically aligned with Republican interests, such as energy, finance, and industrials. This focus on direct political contributions means the MAGA ETF may have less diversification across sectors. It also might overlook smaller companies or those that do not engage in political donations at the same scale, even if they align with conservative values in other ways. YALL ETF. The YALL ETF may have a more diversified portfolio since it considers a wider range of factors beyond just political donations. It could include companies from various sectors, including technology and consumer goods, which might not be heavily represented in the MAGA ETF. By considering corporate behavior and values in addition to donations, the YALL ETF might include companies that are more consistent with conservative principles, potentially leading to a portfolio that reflects a broader interpretation of Republican alignment. Overall impact on investors. Investors in the MAGA ETF are essentially backing companies that are financially supporting Republican candidates, with the assumption that these companies' success might benefit from Republican policies. In contrast, investors in the YALL ETF are backing companies that not only financially support Republicans but also adhere to conservative values in their business operations, possibly leading to a portfolio that aligns more closely with the political and social values of conservative investors. The differences in stock selection criteria between these ETFs lead to distinct portfolio compositions, with the MAGA ETF potentially being more focused on certain industries and larger companies, while the YALL ETF might offer broader exposure to companies that represent a wider array of conservative principles. What sectors or industries are most prominently represented in the MAGA ETF compared to the YALL ETF, and how does this reflect their underlying investment strategies? The MAGA ETF and the YALL ETF both focus on companies that align with Republican or conservative values, but the sectors and industries they emphasize differ due to their unique stock selection criteria and underlying investment strategies. The MAGA ETF primarily selects companies based on their direct financial support for Republican candidates and causes. This focus tends to concentrate the ETF's holdings in sectors that have historically aligned with Republican policies, particularly those that benefit from deregulation, lower taxes, and a pro-business environment. As a result, the MAGA ETF often has significant exposure to the following sectors. 1. Energy. This sector, particularly fossil fuel industries like oil, gas, and coal, tends to align with Republican policies favoring reduced regulation and support for traditional energy sources. Companies in this sector frequently contribute to Republican campaigns, reflecting their interest in policies that oppose stringent environmental regulations and promote energy independence. 2. Finance. Banks, investment firms, and insurance companies are typically prominent in the MAGA ETF. These companies benefit from Republican policies that favor deregulation of financial markets, lower corporate taxes, and a favorable business environment for capital markets. 3. Industrials, manufacturing, construction, and defense companies often feature prominently in the MAGA ETF. These industries benefit from Republican policies promoting infrastructure development, military spending, and reduced regulatory burdens, which are key areas of focus for these companies when contributing to political campaigns. The YALL ETF, while also focusing on Republican-aligned companies, takes a broader approach in its stock selection. It considers not only political contributions but also the overall alignment of a company's business practices, public statements, and policies with conservative values. This approach can lead to a more diverse sector representation, including the following. 1. Technology. Unlike the MAGA ETF, the YALL ETF may include more technology companies. While the tech sector has a mixed relationship with political contributions, some companies within it align with conservative values, particularly those supporting free speech, digital privacy, and lower taxes. The broader criteria used by YALL allow for the inclusion of tech firms that may not heavily contribute to political campaigns but reflect conservative principles in their operations. 2. Consumer goods. The YALL ETF may also have a stronger representation in consumer goods, including companies that support traditional values, promote conservative social causes, or align with a pro-business agenda. This sector can include everything from retail companies to food and beverage firms that resonate with conservative consumers. 3. Healthcare. While both ETFs might include healthcare companies, the YALL ETF could emphasize those that align with conservative principles, such as opposition to government intervention in healthcare or support for free market healthcare solutions. This could differentiate it from the MAGA ETF, which might focus more on companies with direct political contributions. The differences in sector representation between the MAGA ETF and the YALL ETF reflect their distinct investment strategies. The MAGA ETF strategy is more narrowly focused on financial contributions to Republican candidates, leading to heavier weighting in sectors traditionally associated with Republican policies like energy, finance, and industrials. In contrast, the YALL ETF's broader approach allows for a more diversified portfolio that includes companies from sectors like technology, consumer goods, and healthcare, which may not contribute as heavily to Republican campaigns but align with conservative values in other significant ways. This diversification in YALL's portfolio suggests an investment strategy that not only seeks to align with conservative financial support, but also aims to capture a wider spectrum of conservative-aligned business practices, potentially offering investors a broader exposure to companies that embody a more holistic conservative ethos. How do the MAGA ETF and YALL ETF approach diversification within their portfolios, and what are the implications for risk management? The MAGA ETF and YALL ETF take different approaches to diversification within their portfolios, which significantly impacts their risk management strategies and the overall investment experience for their shareholders. The MAGA ETF selects companies based on their political contributions to Republican candidates and causes. This approach tends to concentrate the fund's holdings in sectors and industries that are most closely aligned with Republican policies. As a result, the MAGA ETF often has a more concentrated portfolio, with significant exposure to a few key sectors, such as energy, finance, and industrials. This concentration in specific sectors means that the MAGA ETF might be less diversified across the broader economy. With heavy weighting in industries that benefit from Republican policies like deregulation and lower taxes, the fund's performance is closely tied to the political and economic climate that favors these sectors. For instance, if energy stocks suffer due to a downturn in oil prices or increased regulation, the MAGA ETF's performance could be disproportionately affected. This sector concentration can increase the risk of the portfolio, as the fund is more vulnerable to sector-specific downturns or political shifts that negatively impact these industries. On the other hand, the YALL ETF takes a broader approach to stock selection by considering not only political contributions but also a company's alignment with conservative values in its business practices, corporate governance, and public positions. This broader criterion allows the YALL ETF to include companies from a wider range of sectors, including technology, consumer goods, and healthcare, which might be underrepresented in the MAGA ETF. The broader diversification within the YALL ETF helps to spread risk across more industries and sectors. By not being overly concentrated in just a few sectors, the YALL ETF can potentially provide a more balanced exposure to the overall market. This diversification can be particularly beneficial in managing risk, as it reduces the impact of a downturn in any single sector on the overall portfolio. For example, if the energy sector faces challenges, the YALL ETF's holdings in other sectors like technology or healthcare could help offset losses, providing a smoother performance over time. In terms of risk management, the implications of these different approaches are significant. The MAGA ETF's concentration in specific sectors makes it more susceptible to sector-specific risks and political risks tied to changes in government policies that may affect those sectors. Investors in the MAGA ETF are therefore taking on higher sector risk, which could lead to higher volatility in the fund's performance. Conversely, the YALL ETF's broader diversification offers a more balanced approach to risk management. By including companies from a wider range of sectors, the YALL ETF is better positioned to withstand sector-specific downturns, leading to potentially lower volatility and a more stable performance over time. This diversification also allows the YALL ETF to capture opportunities in sectors that might be less politically aligned but still represent good investment prospects, thereby enhancing the fund's overall risk-adjusted returns. In summary, the MAGA ETF's approach to diversification is more concentrated, leading to higher sector-specific risks, while the YALL ETF's broader diversification across various sectors helps to mitigate these risks and provides a more balanced and potentially less volatile investment option. This difference in approach reflects the distinct investment philosophies of the two funds and has important implications for investors in terms of risk management and expected performance. How do the MAGA ETF and YALL ETF balance political considerations with financial fundamentals in their stock selection, and how might this affect long-term returns? The MAGA ETF and YALL ETF each balance political considerations with financial fundamentals in distinct ways, and these differing approaches can significantly impact their long-term returns. The MAGA ETF primarily emphasizes political considerations by selecting companies based on their financial support for Republican candidates and causes. This focus on political contributions means that the ETF stock selection is heavily influenced by the political alignment of companies rather than their financial fundamentals. Specifically, the ETF targets companies whose employees and political action committees, PACs, contribute significantly to Republican campaigns. In practice, this political focus can lead to a portfolio concentrated in sectors and industries that historically align with Republican policies, such as energy, finance, and industrials. While these sectors might benefit from Republican-led policy changes like deregulation or tax cuts, the emphasis on political contributions can sometimes overshadow key financial metrics. As a result, the MAGA ETF may include companies with strong political ties but potentially less favorable financial performance or higher risk profiles. This approach can affect long-term returns if the selected companies do not perform well financially or if the political landscape shifts, impacting these sectors negatively. On the other hand, the YALL ETF balances political considerations with financial fundamentals more comprehensively. While it also targets companies that align with conservative values, it considers a broader range of factors beyond just political contributions. The YALL ETF looks at companies that reflect conservative principles in their business practices, such as lower taxes, less regulation, and traditional social values. This broader criteria allow the fund to include companies from diverse sectors that may not have strong political contribution records but demonstrate solid financial fundamentals and alignment with conservative values. The YALL ETF's approach allows for a more diversified portfolio, including companies from various sectors like technology, consumer goods, and healthcare, alongside traditional conservative industries. This diversification means that the fund can incorporate strong financial performers across different sectors, potentially leading to a more balanced risk profile. By blending political considerations with financial fundamentals, the YALL ETF aims to achieve a portfolio that not only supports conservative values but also seeks companies with solid financial health and growth prospects. In terms of long-term returns, the MAGA ETF's focus on political contributions can introduce volatility and sector-specific risks. If the sectors favored by Republican policies underperform or if political support shifts, the ETF might face performance challenges. Moreover, concentrating on political alignment might lead to missing out on financially strong companies that do not align with the fund's political criteria, potentially affecting long-term returns. In contrast, the YALL ETF's balanced approach of integrating financial fundamentals with conservative values may provide a more stable and potentially higher long-term return. The diversified nature of the portfolio, combined with a focus on financially sound companies that also align with conservative principles, can mitigate risks and capitalize on opportunities across various sectors. This broader diversification and financial emphasis can help the fund maintain more consistent performance and adapt to changing market conditions, which could benefit long-term returns. In summary, the MAGA ETF stock selection is primarily driven by political considerations, which can lead to sector concentration and potential volatility affecting long-term returns. The YALL ETF, by balancing political values with financial fundamentals and offering broader diversification, may provide a more stable and potentially higher long-term return, reflecting a more comprehensive approach to both political and financial criteria.